What if everything you trusted about money was a lie? Across history, a handful of economic frauds didn't just steal millions, or even billions. They destroyed lives, collapsed institutions, and shook entire nations. In this 5-part documentary series, we expose the 5 most shocking economic frauds of the century, how they were built, how they fooled the world, and how they finally collapsed. These are stories of power, greed, deception, and the warning signs most people ignored. Each episode dives deep into one fraud, uncovering the psychology, the manipulation, and the devastating consequences that followed. If you're new here, this is your regular reminder. Subscribe to the channel, like this video, and share it with others who want to understand how these financial disasters really happened. Most importantly, turn on notifications so you don't miss the next episode when it drops. Because the next fraud in this series might be closer to your life than you think. Let's begin. The Enron Scandal, USA. At the height of its power, Enron was not just a corporation. It was a symbol of American brilliance. It appeared on magazine covers. It was praised by Wall Street analysts. It was admired by politicians and regulators alike. 6 times in a row, Enron was named America's most innovative company. And yet, behind the glass towers and glowing headlines, Enron was quietly engineering one of the most devastating corporate frauds in history. One that would erase $74 billion in shareholder value and permanently change how the world viewed corporate America. This is the story of Enron. From pipeline company to corporate superstar, Enron began as a relatively ordinary energy company, focused on natural gas pipelines. But in the late 1980s and 1990s, the energy industry began to deregulate. This shift opened the door for trading, speculation, and financial innovation. Under Kenneth Lay and later Jeffrey Skilling, Enron reinvented itself. It no longer wanted to be an energy supplier. It wanted to be a market maker, a company that bought and sold energy contracts the way banks traded stocks and bonds. Enron didn't just sell electricity or gas. It sold ideas, models, and future promises. Wall Street loved the transformation. The illusion of endless growth. Enron's biggest selling point was growth. Executives promised investors that Enron could expand into broadband internet, water utilities, global power markets, weather derivatives. Many of these ventures barely worked or failed entirely. But Enron had a tool that allowed it to look profitable anyway. That tool was mark-to-market accounting. Mark-to-market, turning predictions into profits. Under mark-to-market accounting, Enron was allowed to estimate how much profit a contract might generate over many years and record that profit immediately. If Enron signed a 10-year energy contract, it could predict future earnings, book the full estimated profit instantly, report massive income, even if no cash was received. This meant Enron's financial statements were no longer based on reality. They were based on assumptions. If assumptions were optimistic, profits looked spectacular. If assumptions were wrong, losses were buried. This blurred the line between financial reporting and financial fiction. When losses appeared, they were hidden. As projects failed, Enron faced a problem. Admitting losses would destroy its image, so executives chose deception. They created hundreds of off-balance sheet entities, shell companies designed to hide debt and losses from investors. These entities were often secretly controlled by Enron executives themselves. Losses were transferred out. Debt disappeared from financial statements. Profits stayed visible. On paper, Enron looked unstoppable. In reality, it was collapsing. A corporate culture that encouraged fraud inside Enron. Success was measured almost entirely by stock price. Employees were ranked aggressively. The bottom performers were fired regularly. Risk-taking was rewarded, even when it crossed ethical lines. Executives promoted a culture where short-term profits mattered more than long-term stability. Complexity discouraged questioning. Dissent was punished. Employees were encouraged to invest their retirement savings in Enron stock. Executives, meanwhile, quietly sold millions of dollars worth of their own shares. This was not ignorance, it was exploitation. The role of Wall Street and regulators. Enron's fraud didn't survive on deception alone. It survived on silence. Investment banks earned massive fees helping Enron structure deals. Analysts hesitated to issue negative reports. Regulators lacked expertise or willingness to challenge Enron's complexity. Enron spent heavily on lobbying and maintained close political relationships. This is known as regulatory capture. When regulators serve industry interests instead of public accountability, oversight became ceremonial. By 2001, cracks began to form. Cash flow didn't match reported profits. Financial statements became impossible to understand. Debt seemed to exist, but nowhere on the balance sheet. A senior employee warned leadership in writing that Enron could implode in a wave of accounting scandals. The warning was ignored. Executives continued reassuring investors while selling their own stock. The sudden collapse. Once trust began to fade, Enron unraveled rapidly. Credit rating agencies downgraded Enron's debt. Trading partners demanded guarantees. Liquidity evaporated. The stock price collapsed from over $90 per share to nearly zero. In December 2001, Enron filed for bankruptcy, the largest in U.S. history at the time. $74 billion in shareholder value vanished. Human cost of the scandal. The numbers were staggering, but the human impact was devastating. Thousands of employees lost their jobs overnight. Many lost their retirement savings entirely. Pensions tied to Enron stock became worthless. While executives walked away with millions, ordinary workers paid the price. Trust in corporate leadership was deeply damaged. Trials, accountability, and aftermath. Executives faced criminal charges. Jeffrey Skilling was convicted of fraud and insider trading. Kenneth Lay died before sentencing. Accounting firm Arthur Andersen collapsed after its role in document destruction. The scandal led to the Sarbanes-Oxley Act, tightening corporate reporting and accountability laws. But no law could undo the damage already done. Why the Enron scandal still matters? Enron wasn't just a corporate failure, it was a systemic one. It showed how complexity can conceal corruption, innovation can disguise deception, greed can override ethics, oversight can be neutralized. Enron didn't collapse because no one was smart enough to understand it. It collapsed because too many people benefited from pretending they did. Enron was once celebrated as the future of business. Today, it stands as a warning. A reminder that when transparency disappears, accountability fades, and trust becomes a weapon. Because the most dangerous frauds aren't hidden in shadows. They operate in plain sight, backed by reputation, protected by complexity, and enabled by silence. What you've just watched wasn't just a story about money. It was a story about trust, power, and what happens when deception goes unchecked. And this was only one chapter in our 5-part documentary series on the most shocking economic frauds of the century. If this episode made you think, question, or see the financial world differently, subscribe to the channel and share this video with others. It helps more people understand how these frauds happen and how they can be avoided. The next episode in this series will expose another case, another scheme that fooled millions and left devastating consequences behind. So make sure you turn on notifications and watch out for the next video in the series. Because the next fraud we uncover may be even more shocking than this one. See you in the next episode.